Hello, everybody. Welcome to Clef Investments. Today, let's talk about Nasdaq 100 ETF or fund. What's the best way to buy Nasdaq 100? So we have been talking about two important indexes, S&P 500 and Nasdaq 100. So for Nasdaq 100, what are our choices? So there are ETF, QQQ, which is a very popular ETF. It has a management fee of 0.2%. Every year, it'll take out 0.2% from the ETF. Compared to the other one, QQQM, QQQ is more liquid because every day there's about $16 billion of QQQ traded on average. And this is a very big number. It's the second most traded ETF in the world. The first one is SPY, S&P 500. Another one is a QQQM. It has a lower management fee. So both those ETFs are created by the same company. Why QQQM was created? Because many investors really like Nasdaq 100. They want to buy QQQ and they complain that 0.2% of management fee is very high. The company said, well, QQQ is way too liquid. It takes lots of money to manage, so they cannot really lower the management fee. But instead, they opened a new ETF called QQQM. And for QQQM, they expect investors buy and hold so that it is a little less liquid than QQQ. And its average trading dollar is only 0.4 billion per day. So there's a 40x difference. Although it's less liquid, it's still liquid enough. If your account cannot buy ETF, you can only buy a fund. You can search these two funds, USNQX with a 0.42 management fee and IVNQX with 0.29% management fee. So both have a higher management fee than QQQ or QQQM. So now we know that there's a small difference between the management fee of QQQ and QQM. If you already have QQQ, there's no point to sell them, pay the capital gain tax, and then switch to QQQM. But if you are buying new stocks, then why not buy QQQM, which has a lower fee? So you may ask, well, does it matter? It's just 0.05%, a tiny little number. But let's look at a real example whether it matters. So Nasdaq 100 index was created in fall of 1985, and from that day until yesterday, when I made the slides, that's the longest history I can find, and it has grown from $110 to $21,774. So that's almost a 200x increase, and it spanned 14,373 days. So you can calculate the annual return is 14.3%. So this is a very high return. So if you know the 72 rule, you know that after every 5 years, your account would double on average. Remember, this has included the dot-com bubble at 2000. So it dropped and then it come back. And still, it has an overall 14% annualized return, which is much higher than S&P 500. And by the way, this is just the index price. And I did not include the dividend because there's no easy way to find that out in Yahoo Finance. So because every year, if you buy QQQ, it has a 0.2% management fee. So that means its annual return will be reduced by 0.2% down to 14.1665%. For QQQM, it's a little higher. It's 14.2165%. So let's see, with these two difference, how much difference we can get in the end. So assume you start with $1 million, and after 30 years, for QQQ, it becomes $53 million, and for QQQM, it becomes almost $54 million. So the difference is 704,000. So this is about a 1.3% difference. If you times the difference 0.05% by the number of years, 30 years, you get 1.5%. So it's very close. So basically, the difference is the management fee difference times the number of years. And if you wait for 40 years, your QQQM will become $4 million, and QQQ is only $200 million. Both are huge numbers. And again, the difference is $3.5 million, roughly 1.7%, and also very close to the annual difference times 40 years, which is 2%. Okay, so this means although there's a small difference, if you are buying new stocks, it's worth to use QQQM. Later, if there's a bear market, you need to do tax harvesting. You need to sell some Nasdaq 100. Then you better pick those with the highest cost basis, even if that means you are selling QQQM, because the difference in cost basis can make a very big difference in the capital gain tax you want to get rid of. So that is still bigger difference than the 0.05% of annual difference. Okay, that's all for today. Thank you.